Welcome back. This is Chart Overload, and I am Ryan Mumy, the CEO of Celinda Capital Management. And joining me, Justin Greenhill, our Chief Investment Officer, for this edition, beginning of November version of Chart Overload. In Chart Overload, we go through a bunch of interesting charts that I think's Chart Overload, and Justin disagrees. But we talk through it through our lens, what we think it could mean. Again, just to educate, give you another viewpoint on what's going on out there in the intricated web that is the global financial markets. Justin, you ready to get started?
Intricated.
Intricated. Let's start with the big picture. How NVIDIA and OpenAI fuel the AI money machine. Some have called this the AI flywheel. We talked about it on our recent webinar. But yeah, there's a lot of dots that are connected and firms that are connected.
Yeah. So this graphic came from the most recent quarterly webinar, big picture graphic, but most importantly, the keyword is connected. So the deals they're doing are with one another, and many of them will happen at some point in the future. So there's a bit of a
Allegedly,
there is a bit of a hype cycle, but nonetheless, as we'll see in the next graphic, results have been seen across their product.
Yeah, this next chart just looks at, the number of articles that were written by humans are generated by AI, and there's been a significant spike in the use of AI for writing articles.
Yep. So the question, obviously, back to the intricate web of business dealings between the giant AI technology companies. The question is not if they will come out with products. It's just, will they make as much money as they would like from those products? I think is the
revenue's not there yet.
Right.
Yeah. He didn't use the southern version of intricate.
Which is?
Intricate. We talk.
Interstate.
Don't run from your southern roots, Justin. Moving on to this next chart, looks at the forward price to earnings ratio of the S&P and the NASDAQ, and they're up.
Yeah, high levels, led by the blue line, NASDAQ 100, which back to the AI situation. But if one wanted to look across the entire scope of history and one wanted to look at the biggest bubble in history, which was the dot-com bubble, you could say we're below that. So that's
we talked about that. We've talked about it a couple times, that while there are some similarities, one thing that's not is many of the Mag 7, the participants now, many of them actually have earnings, and they didn't back then. But again, to be determined. We'll keep watching. Next slide looks at Schwab. Had a record for net new assets from their retail clients.
Yep, money keeps pouring in. So headline reads, new assets up 48% on retail investor demand. It's not 4%. It's not 8%. It's 48%.
40. That's a big number. And that, going into our next chart from friends at Investec, Jim Stack, well-known market tactician. He put this out. It's data from the Federal Reserve, but it looks at the corporate equities as a percentage of financial assets for U.S. households, and as we see here, we've clipped all-time highs somewhere else.
Yep. So, 2 words: all in.
Next one in the big picture is we're looking at CPI inflation data, and just hot news came off the press. It was a little under expectations today when it was released, but it remains above the long-term bogey. But have the goalposts been adjusted that we've talked about in the past? What are your thoughts here, Justin?
Seems that way. I think the bottom line is most important. Year over year is 3%, which a long time went where they would not tolerate above 2%. So the market's reaction today, as of Friday, October 24th, is this is going to allow the Fed to continue embarking on, an aggressive rate cut cycle, perhaps 2 cuts by year end.
Yeah, we also saw that shift, that CPI print shift the futures market on expectations for future hikes. They're pretty much locked in on 2 at this point. Next section, looking at U.S. stocks. This first chart looks at 3-month forward returns from a seasonality standpoint, and we're entering some good periods.
Yep, this is a very strong seasonal part of the year that we just entered into after coming into what is, at least historically, a seasonally weak time of year for the stock market. So, all in.
Yeah, that's your word.
The theme of today's show is
all in. Interesting though on seasonality, that remember it's sell in May and go away, and that didn't work out so well for people. So as we've said, you can't take one data point and fit your entire investment thesis to. I mean, you can, but good luck at being a repeatable process. But weight of the evidence, we have to understand that right now seasonality is traditionally strong. Moving on, additionally, another possible tailwind to equities is the blackout period for corporate buybacks is about to end.
Yep. So another potential buying source that could come into the market just at the time, moving to the next chart, where positioning in the market is not low, but one couldn't say it's crazy high either relative to the amount of money that's out there into the system.
Yeah, it's reading neutral. It's not too hot. It's not too cold. So again, we'll see. Justin and I had a conversation literally this week, end of last week, beginning of this week, that based on various signals, I mean, the market could go either direction. And despite lots of negative headlines, despite lots of news, it's held in, and you've got to respect price and trend there. Next chart looks specifically at the Russell 2000 small caps, and what we see here is horizontal line has been breached.
Very relevant chart, we do believe. So highlighted yellow lines are prior all-time highs, and as one can see, Russell 2000 just broke out to new all-time highs for the first time in several years, and has since pulled back to those all-time highs 2 or 3 times, and as of today at least, moving higher still yet.
Yeah, resistance becomes support, and we've seen that play out at least in the last couple of weeks, because we've talked that small caps were lagging, and if a bull market was to continue, there would have to be some expansion where more companies were participating. And again, that kind of jives with that thesis that we had. Moving on to stocks outside of the U.S. This just looks at a ratio of the ex-US major ETF versus the SPY, which tracks the S&P 500.
Yeah, I mean, we've covered this chart a few times over, but we think it's relevant to update. And what you see here is after years of underperformance by non-US stocks to US stocks, this year that ratio is starting to potentially make a bottom. So I think what that means is despite the fact that international stocks have had a good year, if in fact we do believe that relative performance is cyclical, we could be still very early innings in that regard.
BBD. Next chart looks at Taiwan Semiconductors. We've shown this one before. It's a simple, how is it trading here in the American exchanges relative to its Taiwan shares, and well, it's gotten bigger.
Yeah, so whether this is a function of investors being more speculative or risky in the US market, or it's a function of there's just more liquidity in the US market and that liquidity wants to buy Taiwan Semiconductor. Nonetheless, that is something notable, is just how bullish the sentiment is amongst US investors relative to the rest of the world for the stock market.
And the question is, could it expand further? We don't know, but we have the data that we'll continue to monitor. Next chart looks at, it's been a hot button issue is rare earth reserves. This just looks at where the metric tons of rare earth minerals are located, and we have a winner.
Yeah, China's the dominant winner, and then China also does the processing, which rare earths require a very extensive and potentially environmentally damaging processing. But interesting, the by far second leader on the list is Brazil, which, although it does have reserves, it hasn't really yet started to build out its industry of rare earth mining. So that could be a future tailwind.
Interesting. Next chart looks at, again, taking a look at CPI, breaking it down over different time frames and in comparison. And there's some interesting stuff here. It's still hovering, where it's been for a couple of years, but the question is, what direction is it going to continue from here?
Yeah, so this graphic is just the CPI in Brazil with the nominal interest rate in Brazil, and it really is providing some explanation to the previous chart, where if interest rates are high, Brazil is obviously having trouble domestically financing the need to get all those rare earths out of the ground. So the question here is, with the China situation, will the U.S. and other, countries that would like to see rare earths diversified outside of China, will they start to put some capital in and go for those reserves, considering, or will interest rates go lower in Brazil? But 15% interest rate with less than 5% inflation is, a headwind to taking a lot of risk in the stock market, or especially in private investments.
Yeah, I mean, that's one of the things that Justin looks at closely. We look at closely in foreign countries. The interest rates relative to inflation matter a lot more than they necessarily do in the United States. They matter here, but they're also not as volatile here. So they can tell us a whole different story about not just the direction of the markets, both fixed and equity, but also the real economy, and that's where the rare earth business lies. Moving on to interest rates and credit. First chart just looks at the 10-year U.S. Treasury.
Went sideways for a few years, and starting to bias itself lower. So, which would make sense, right? We mentioned the fact that inflation has now sort of steadied and been accepted at 3% versus prior it was 2%. It would make sense to think that perhaps the 10-year yield, at least not in the current backdrop, is going to go back to those levels, lower levels. It might just hang out here for some time. But it has moved, a bit lower. 4%, 4.5%, many believe, are kind of key levels, and we're what would you call that? Low end of the range.
Yeah, and as we've said, oil prices also weigh in on the 10-year yield. So many things weigh on it, so it's hard to say what's driving it. And I can say one of the question marks hanging out there is the tariff impact. What will it actually be to inflation? Will it be a one-time or more of a reset of expectations? That will weigh on the 10-year as well as the other things in fixed income. Next chart looks at the Fed's reserve, and many believe that it's been overdone in drawing down its reserve funds.
Yeah, and this ties into a chart we've mentioned here. I believe it was in the quarterly webinar, where just the funding stress within the banking system has gone up. And, historically, you see a chart like this where reserves have dropped in banks and so on. historically that was a headwind to the economy. The difference being is now almost all the economic activity that exists in the economy comes from private credit, not from the bank channel. So there are many that are starting to just say that, interest rates and funding dynamics within the Fed are maybe less important than ever. It's really kind of the animal spirits and the, withdrawals, redemptions, or contributions of the private credit market, private equity, etc.
Yeah, which has grown tremendously. Private equity and private credit has grown tremendous amounts. As what we talked about earlier, there's more and more money sloshing around the economy looking for a place to go to make an investment. Again, next one, similar concept. This looks at a way to look at credit risk in the U.S. corporate bond world, and as we see here, that's not showing any signs of stress.
Nope. And one could maybe make the argument that these types of conventional metrics are maybe less useful because of everything we just said. But at the same time, what was the phrase of the show? All in.
All in.
All in.
All in.
And
Investors are all in, not just in equities, but in fixed income as well. I mean, I saw a chart that U.S. Treasuries for a period of time were yielding more than Microsoft bonds, right? Which indicates people are less worried about in theory, they're less worried about Microsoft failure to pay than they are the U.S. governments. But again, just interesting. Moving on to our last section, talking about commodities. First chart, let's take a look at black gold, crude oil.
Black gold. Interesting chart here. Basically, the recent move lower in the price of oil went right back to what was the Liberation Day or around Liberation Day early year risk off period. And since then, market got a little bit of Russia sanction supply side narrative, and we're bouncing off those levels. So those look to be, as Ryan said earlier in the show, that's a horizontal line.
Yeah, and you got to respect the horizontal line until it's broken. Next chart looks at silver and gold. Is anyone with the pulse knows they've went up a lot, and they also both seem to hit a little bit of a ceiling in the last week, where they sold off pretty hard.
Yeah, this chart is from Spectra Markets, and it's really interesting in that the red arrow is a increase in the CME margin requirement. So all that simply means is the exchange made people deposit more money to have the same amount of levered risk. And a lot of commodities, at least near term, do top on those dynamics because it makes it more expensive to stay with the position. And if the position then starts to get more volatile, it then obviously can create some selling. And sure enough, that was pretty much the top in both gold and silver.
Yeah, I mean, at least in the short term, but I mean, tops, bottoms are always at some point bottoms and tops in the short run until they run a little longer. But that's something we watch. Other people have talked about with gold, that the bunny ears there being a double top. But again, who knows? Time will tell, and we'll keep watching. Final chart for this show, for this episode of Chart Overload is coffee prices. Cost of your cup of Joe has went up.
Interesting chart here. Black line is Arabica coffee, which is mostly in Brazil and in Colombia, and the other is Robusta, which is mostly in Vietnam. And there's obviously some in Latin America too. But what ended up happening last year was the Robusta crop. There was a problem in the crop in Vietnam that then shifted over and actually created sort of a reflexive thing, along with some weather patterns in Latin America that then moved the Arabica crop price up. So we've kind of seen this rolling price spike amongst a bunch of niche commodities over time. It was cocoa, it was coffee. We highlighted in this show, I believe, a couple times what happened in copper. We've recently seen it in gold. And I think this just goes to show that there are some very interesting and relevant fundamentals that go into these commodity markets, but there's also a lot of speculation that can come in as well.
Tag all in.
All in.
People with the money, I mean, speculators are going to speculate, right? And yeah, good stuff. We appreciate you joining us again for this edition of Chart Overload. We certainly know you could spend a lot of different places with your time, and we appreciate you spending it with us. If you have any questions you want to discuss, maybe more long form, one of the topics we talked about, you can email us at info@solinda.com, info@sollinda.com. You can always give us a call, 844-662-1211. But again, appreciate your time, and we will see you next time.